All right, so welcome into the live stream today. I'll make it short. We're going to jump over to the FOMC meeting with Chairman Powell, kind of jump into what's happening, not only Bitcoin, but also we'll look at some sentiment today, drive into all that good stuff. Thanks for tuning in, and welcome into TechPath. Let's go over to Chair Powell. We'll just go live because he's on right now.
0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really.
So that's interesting with that point right there. And some of the comments here in the sidebar is that they are talking about the fact that he said in his last meeting that this would be a longer lead time to get to a 0.75 basis points. And in fact, it was not. So he kind of backtracked a little bit there. I think he is kind of getting called out on it, but let's see what she has to say.
75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this.
21.4, so
we've been moving rates
quickly
up,
on a sharp incline
expeditiously
at
to more normal
21.4 after it
levels.
had
And
pretty much hit
over the
its
course of
bottom
the
this morning
7
right
months
at 20,000.
since we pivoted and
to
began
20,003.
moving in this
So
direction.
this
we've
seems
seen,
positive right
financial
now,
conditions
at
tighten
least based on
inappropriately
what people are
But
expecting.
the
So there
federal
may be
funds
some
rate,
things within
even
this
after
that
this
we need to
move,
really pay
is
attention
at
to.
1.6%.
What he's talking about.
Again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to
Yeah,
have
and
more
just remember,
optionality.
on the last FOMC meeting where we had the 50 basis points in, the issue was that Bitcoin took off and then we had an immediate correction, which was over-corrected downward. So just remember that. We may be seeing some market euphoria here within this.
Restrictive level at the end of this year, and that's 6 months from now, and so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If
Key
things are
word
better,
there, he said
we don't
6
need to
months
do
from
that
now.
much.
So
So
anticipatory
if they're
issues
not,
with the
then we
Fed,
don't
definitely
need to do
looking
that
at a
much or
longer
possibly
lead
more.
time
But in
on
any case, it
where
will be very data
we're going to be
dependent.
looking at
Then,
inflation
looking at
numbers
next
here,
year,
which
and
will
what you're seeing
cause
is people seeing
continuous
more-
rate hikes throughout the
bit
end of the
more
year.
tightening
Again,
and
this
in a
is
range of maybe
a
3 to
scenario. We may
4%.
see a
And
little
that's
bit of a
generally
slide
what
time
people
here
see
with Bitcoin and
as
most crypto
the
markets,
appropriate path
unless I don't necessarily
for getting
think,
inflation
based on
under
what he's
control
saying, is that
and
we've seen the
starting
bottom.
back down and then getting back down to 2%. So 75 basis points seemed like the right thing to do at this meeting, and that's what we did.
Yeah.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year.
Yeah.
Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%.
Curious if you
And
guys
how
think
do you
he
think
is
about that?
hawkish
Well,
on
you can
this,
think about
or
the-
if you think
the
he
longer
is
run neutral
dovish
rate,
on this.
you
Is
compare it to that.
he going in a little
So the
stronger,
returns
or do you feel like he's backing off at all? Just based on
Financial conditions.
body language, what he's saying,
Asset
your
prices,
thoughts?
You can look at the effect you're having on the economy, rates, asset prices, credit spreads, all of those things go into that. You can also look at the yield curve and ask all
Take a
along
look
the
at the
yield
chart.
curve, where is
So you
what,
can see
where is the
Bitcoin on
policy
a
rate? So
immediate
for much of the
punch.
yield
We're almost
curve
at
now,
22.
Real rates are
Punching
positive.
out at
That's not
22.
true
This
at the
is a big
short
move.
end.
If you were
At the
buying
short end of the
Bitcoin at
yield curve,
20,000,
in
there's
the
your
early
chance for a
years,
swing
you
trade
don't
right
have
now.
real you have negative
Likelihood
rates
is
still.
we had 20. Here's the
So
red
that-
candle starting to
there
form.
really is
We'll
one
see how this
data point.
goes.
It's one
I mean,
part
it's
of financial
eerie
conditions. So
how
I think-
close this is to how crypto is tracking FOMC. If you watched our stream earlier today with Andrew, go back and look at that, because he talks a lot about the Fed and why it's less important in the markets than what we are applying it to. So just
Do we think financial
take a look at that
conditions are in
video.
place where they're having the desired effect on
we're gonna
the
get to some
economy? And
questions.
That desired effect is we'd like to see
Dovish, okay.
demand moderating.
Okay, so this is a good
Demand
point,
is very
Dean.
hot still in the economy.
Dovish for
We'd
sure.
like to see the labor market getting
Gonna
back better
tune in
in
for the
balance
election,
between
which
supply
is something,
demand.
and
that
there's
can
some
happen
news out
both
on
from
that that we'll
supply
jump to as
demand.
well.
Right now, there's demand
Kevin
is
says
substantially
hawk,
higher than
hawk.
available supply, though. So we feel that
Dovish.
there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't
Hawk
affect.
Hawkish.
And those would be,
Body
the
language.
things, the
He's
commodity
defensive.
price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think
Does it get
it's
it done?
certainly in the range of plausible numbers. I think we'll know
All right,
when we
so
get
that's a
there,
no.
really. I mean, honestly, though, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but
So
what?
he's
We're
waffling
gonna
on that
det- we're gonna
question,
find
which
that
was
out
a
empirically.
direct
We're
on
not-
with him of
we're not
whether
gonna
this would be
completely
enough.
Model-driven about this. We're gonna be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Yeah, and I think here we go, guys, because you're
Thanks. Nick
looking at a
Timrose of
couple
the
of
Wall Street
scenarios.
Journal.
Let me see
Chair
what Wall
Powell,
Street
you've
has to
said
say.
that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based.
No,
And
no
I think if
straight
you look
answer. He
across
was
that
kinda waffling
broad
on that.
range of data, what you see is that
definitely
expectations
not
are
a
still
soft
in the
landing.
place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look,
Yeah.
for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question. We take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we
So that,
noticed
what
that.
you just said
We
there,
also
a couple
noticed
of
that
indicators.
the,
They're watching this so granularly that any little move on CPI, potentially retail, all of this could play. Job numbers will start playing into this toward the end of the year. So watch third quarter.
As I mentioned, one of the factors in our deciding to move ahead was 75 basis points. Today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
Important.
You know, I'll just say, we're going to react to the incoming data.
Not good.
And,
Not good.
Appropriately, I
That
think.
was not a good
So
answer.
I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty
If,
soon
you
we'll
hit,
be in an
if
area
we're
where-
getting a
where
negative
we're-
CPI or
I
a
think
down, look
as
at
you get
this. This
closer
is
to the end of
crazy.
the year, you're in a range where
Of course,
you've
you
got
either answer
restrictive
that
policy, which
it's
is
not going to work,
appropriate,
or we're going to continue to put
40
pressure on it.
highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So
Yeah.
I think that's how we'll take it.
Yeah, we're going to see a few pumps on some altcoins for sure there.
Hi, Chair
F the
Powell. Neil
system.
Irwin from Axios. Thanks for taking our questions. The late
see your-
breaking kind
we
of
see
decision
your,
below 75 basis
your questions
points.
coming in, your
Do you worry
comments.
that that will
Actually,
make
we're
policy
trying to
guidance
drop in a
less
couple of these.
effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation, or if the labor market starts to roll over?
To take your second question first, yes. I mean, I
Labor.
think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry,
Yeah.
and your question was guidance. So again, the overall exercise is that we try to
One's
be
coming down.
provide as much
Bitcoin
clarity about
sliding
our
back
policy
into
intentions
21.4.
as we can,
Not a
because
good
we
look
think
right
that
now.
makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this
Messi,
year
he
has been
said
a demonstration
0.75,
of how
everything.
well it can
I
work.
mean, we kind of, market was baked in for 0.75. The concern right now is a bit uncertainty, and I feel like we're getting a little bit more hawkish response from him. But yeah, I'm going to watch this 2 or 3 times to really kind of dive into every word he's saying, because you really need to understand that there's a lot of things being said here that is between the lines.
It's always going to be, any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, you know, we're looking
That's an
for
interesting
something
statement,
specific,
as
and that is
about as we expect,
progress
which
on
has not
inflation.
worked out
We
so
wanna see
far.
progress.
So they've
We wanna
had to
see
kind of basically call an
inflation
audible
go down
on the
until it's back
0.75, because they were looking at a
That's what we
0.5.
want to see.
Did not see the 0.75 till here recently, and then had leaked that information out.
If we don't see
and off we
progress
went.
for a longer period, that could cause us to react. But we will, soon enough, we will be seeing some progress at some point.
Which is why we
And-
see
and-
sub
and we'll
25
react
Bitcoin. I
appropriately
mean,
to that
all of
too.
this
But
is
I would
because we're
like to
below
think,
the
though, that
25. This has
our
been the
guidance is
pressure
still
that's been on the
credible, but
markets.
It's always going to be conditional on what happens. This is an unusual situation to get, some data late
All right, so he's backing
in,
up.
during blackout, pretty close, very close to our meeting. Very unusual to one that would actually change the outcome. So
Yeah, so there he is, saying that data was the deciding factor here, and it came very close to the meeting. Likelihood is we're going to see this more in the summer months and definitely in the fall as we start to see a lot of the earnings coming in. New question coming in.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP?
he's not gonna
if
answer that.
inflation is not moderating, at this acceptable pace.
so the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series
Listen
of
carefully.
declining monthly readings for inflation, and we'd like to see inflation headed down. So, but and right now, our policy rate is well below neutral, right? So soon enough, we'll have our policy rate, let's assume the world works about like the SEP says, the policy rate will be up where we think it should be. And then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking.
Yeah,
Ultimately,
he's not answering that one. Okay.
We're not going to declare.
So what she's talking about is as we start to see employment, because right now we're seeing basically the responses, and obviously you guys see this in the crypto space, all the exchanges and a lot of the big companies starting to cut back on expenditures, lay off workforce, all those kind of things. These kind of will roll out in Q3 and Q4. We talk about this a lot on the show. And he's sidestepping that, because if we see that happen in Q3 and 4, and not a slowing of pricing, which is the big concern,
Implementation of our policy is going to be
we're going to continue to see
flexible
this push.
and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
Here's the big one.
Again, I
Oh.
think that
Head bobble. I don't like
I
head
do
bobbles.
think that
Head bobbles worry me.
their objective, and this is what's reflected in the SEP, but our objective really is
This is crazy.
to bring inflation down to 2%.
I just feel like I'm calling
the labor
a
market
soccer
remains strong.
game here.
I think that what's becoming more clear
That's
is
positive.
that many factors that we don't control are going to play a very significant role in
All right, so
deciding
he's
whether
backing
that's
away from that
possible or
question
not.
as
And then
well.
I'm thinking,
All
of
right, so
course,
we're getting some really clear answers.
prices, the war in Ukraine, supply chain,
Right
things
back.
like that, where
War
we
in
really
Ukraine.
we really
Supply
can't.
chain, said that
right,
twice.
The monetary policy stance doesn't affect those things. So
Looking down, not
but
good.
having said that, there is a path. There's a path for us to get there.
Having said that, he
it's
didn't
not
say
getting
anything.
easier. It's getting more challenging because of these external forces, and that path
Yeah,
is
this is
to
definitely
move demand down.
his hawkish position. He is trying to build in a safety net here for this hard skid landing that we're dealing with right now.
So
We have to be real on this and understand this is not what
actively seeking a job.
we kind of expected. A little bit more light, but the data is not there to support the potential for us to see slowing CPI. So if CPI continues, which I anticipate it's going to, based on overall sentiment numbers, all that flowing into this,
People are still getting
definitely going in.
healthy
All right, so
wage
we're coming back
increases,
down
real wage
here at
increases,
21.4.
but at a level that's consistent with 2%.
So hopefully you guys
inflation.
took a little profit
So
there at the top
That's
on
a
that little
possibility, and you could say the
little,
same thing
scalp
about some
trade.
product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have
Right.
the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see,
Yeah.
and it's not guaranteed, but you could see prices
Tough to get
coming
to
down
them.
more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Yeah. Again, not an answer. All right, so he's
Hi, Chair
sidestepping pretty
Powell.
well.
Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So you're right. In the SEP, we have unemployment going up to the median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that
We
if
will
you
blow
were to
past
get
that
inflation
median
down
number.
to, on its way down to 2%, and the unemployment
Yeah.
rate went up to 4.1%. That's still
geez.
a historically low
99%.
level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year
Quick.
in
All
the
right,
last
let's take
50.
and see what's
So
going
the idea that
up here. All right, will Bitcoin
3.6%
continue
is
pulling up Fed
historically
meeting?
low. in the
Staying
last
above
century.
20K, yes,
A 4.1%
Bitcoin going
unemployment
under.
rate with
All right, 60% of you
inflation
guys
well on its way
this.
to 2%. I think that would be, I think that would be a successful outcome.
Yeah, this is
So
one of those short-term.
We're not looking to
short-term
have a
hits,
higher
even though we got a
unemployment
green
rate,
candle
but
coming
I would
back
say
in
that
at
I would certainly
21.6
look
here
at that as a
during the
successful
FOMC meeting.
outcome.
Does that include people losing their jobs or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want
Careful.
without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where where workers are getting wage increases. Maybe the workers at the lower end of
Yeah.
the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities. Where
Clearly,
it's just
this is going to
really- I
be
mean,
a pressure heavily on the American workforce, and it's going to come through these kinds of implications for businesses who are going to be pushed into making some decisions, which is a problem because obviously we're going to see slowing of retail sales. We're going to see a raising of overall inventories. I was just pulling up an article on this on U.S. business inventories rising strongly as sales start to slow. This is exactly what I'm talking about. If this starts to be the case, then that will have the ripple effects on all retail centers, along with some of the biggest categories in terms of food, energy, all those kind of things that really start to play into people's jobs, especially the middle class. So let's listen back in.
Policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though, so I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence.
So ETH looks like it's sliding.
Clearly, it's our goal to bring about
let me jump
2%
to,
inflation
go
while
over to
keeping
the
the labor market
single
strong,
shot on
right?
Powell.
And that's kind of what the SEP says. That the SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate, so we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen, again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation, really since the consequences of the Ukraine war become more and more clear.
As we get in
what you're
deeper,
seeing-
he is leaning heavily on this. The war, obviously, the war is an issue, but he's leaning on it way too much, as opposed to the economic conditions of the U.S., which is more important. I understand that's global, and if that war were to stop, we'd probably see somewhat of an impact, but we wouldn't see an immediate turnaround. So,
prices, all-time highs and things like that. That's not something we can do something about. So that is
exactly
really,
right.
And by the way, headline inflation is important for expectations. The public's expectations.
yeah, we are going.
Why would they
at,
be distinguishing between
full tilt here,
core
guys.
inflation and
More
headline
about
inflation?
this,
Core
because
inflation
if you look at the current, let me jump over to our own sentiment data. Let me see if I have that pulled up.
experience. They don't know what core is.
Let me
Why
pull up
would they have
that. Yeah, let's take a look. This is the markets this morning from our data on Bitcoin.
headline inflation?
as you can continue to see right here, the slide off. I mean, we've already seen this printing on Monday on a negative. We went from a 69 to a 7. This is on overall sentiment. We are now down at a 63. So far, we have not recorded, at least in the history of the time that we've recorded, a sub 60 Bitcoin in overall sentiment, but we are on a sub 60 overall market and a sub 60 amplification. Now, what does that mean? It's the sentiment that's coming into the place or into the markets from what people are talking about within crypto itself. So mostly social media driven, obviously, but this is the market sentiment. If you look at Ethereum, also just literally plummeting, 52.12. This is why I do think Ethereum, we will see a sub 1,000 number. And if we continue to see the pressures on the businesses within the crypto community in terms of layoffs, all those kind of things, this is something to watch. Let's jump back to the FOMC.
Some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see.
They're spending into credit. Credit is going to cause a problem if we continue to spend into credit.
Gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels.
Broad slowdown definitely coming right here. We're going to see this cause a broad slowdown on retail for sure.
How closely are you watching consumer spending, or is there
this is 1994, the last time we saw these kinds of
It would be hard to watch anything much
1994,
more closely
guys.
than we watch consumer spending. But we watch everything. You know, we watch business fixed investment, which actually has softened a bit. And
this goes back to our, if you haven't watched our previous video today with Andrew Horowitz, he talks about this issue right here is how, I hate to say the word stupid, but how inefficient the Fed really is in being able to kind of predict and understand how to accommodate and help soften this rollout, because this was so abrupt into a market that is basically now in these kind of situations, which is somewhat of a shambles.
To deal with
sub
higher
25K
interest rates.
Bitcoin.
Thank you, Mr. Chairman.
Back here
Mike
on
McKee from Bloomberg
21.6,
Radio and Television.
Going sideways a little bit
Are
here.
you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. We, of course,
Green dot
like all
printing
central
on
banks
market
do,
cipher.
look
This is
very, very
interesting.
carefully at
Money coming to the market a little bit here. Interesting.
It's a much better predictor.
Again,
of where
sideways
inflation is
action
going.
for 0.75. I mean, as expected, I think a lot of people were anticipating we'd see some sideways action and then potentially an adjustment off of that, because I think the ramifications of what he's talking about right now are what we have to watch for, and that is going to be, as we've talked about before, is issues with layoffs, issues with slowing economy, higher issues with retail inventory starting to rise, which is going to cause some loss in terms of overall jobs, but it will also cause a slowdown of price increases, and that's the one thing that they are trying to adjust, which could adjust the CPI. So this is definitely a little bit of a balancing act.
Again, we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the
and
same
that is a
factors
concern.
that led you to?
Is you guys are in the comments talking about credit. This is a concern. It's one I've talked about in past shows for months. Is that a credit crisis could near toward the end of this year and Q1 and 2 of next year, because of the pressure on pricing to the American consumer, having to lean into savings, having to go into the credit cards, and creating more debt, especially when they've been maybe buying a house and now their situation is upside down. If they bought a car, they're essentially going to be in upside down positions. Granted, they will have lower interest rates, but equity positions will start to disappear. So it'll start to create some issues there.
Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role
So
that we can
this
play,
is not
maybe
kind of it's not a nothing question, but it's a situation he's not going to answer this one either. In the sense of he's sidestepping a lot of these issues, probably because of lack of data and understanding where the market is rolling, and that is accepted to a certain extent. But we're talking about the Federal Reserve. We're talking about what should be the best economic engine in the world to be able to understand what's happening in the U.S., especially in the U.S., in the essence of where growth and scenarios are coming. You've got credit crises coming. You obviously have pressure on markets that are really pushing. You guys are asking what's the next potential, safety net for Bitcoin? Where is the next resistance? Remember, we have not hit the 80% down from our 69 high, and we're about to bump into our last all-time high of 2017 at 19K. So I think 19K is the next hit. If we pass 19K, that will be the one that we will be in trouble with, because we will not have any kind of resistance. We'll have a free fall.
Would be
And
to
that's a
fail.
problem. Yes,
it's
it is a
not
fake
an option.
problem.
We have to restore price stability. We really do, because
This is
everything
sideways.
it's
If
the
this
bedrock
was
of the economy.
dovish, the market would be much more active than it is right now. Volume not necessarily that high. We're printing a red dot, so we're getting ready to see some exits on this. We are in the minute chart right here.
In any kind of fundamental way, we don't think that we're seeing a wage price spiral.
Money flow is
We
not
think
definitely
that-
money
that-
flow
that
crossover
the-
is not
the
definitely
public,
not running it in. So again,
it generally sees us
lots of
as
interesting
very
things.
likely to be
The point I'm going to make, and I will rewatch this, guys. I'll probably spend a few hours just combing through every word he said. But there was many things that he's got into around where this market is going, and this is going to have some effect on the next layer of politics. You got Elon Musk here tweeting that he's going in with Ron DeSantis for president. This may be decided now. If we get a Musk behind a Republican president outside of Trump, that could really change things with obviously the course. This also could start to correct economically what we might see in the markets because of the potential upside for this, and especially as people are looking at long term. Because remember, you've got to come off and scoop that bottom on all these markets to be able to see the light. That's all that investors need, is to see the light. And then they'll start pouring the money back into the market,
Really
which
for
is
the
where
first
everybody
time.
wins.
Because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the really critical question from the perspective of doing our job is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris.
Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, and where do you see those going in the near future?
So as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but so you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does.
Yeah.
Is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Not really.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible? And how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. I would call that as meeting that test. Do I still think that we can do that? I do. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it, there's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Yeah, probably not going to happen there.
Thank
you go,
Greg
Queen.
Robb from
Tell 'em.
MarketWatch.
Preach.
Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates.
Risk?
So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And if we did another, we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on.
I would agree.
And by then we'll have seen a whole lot more data. As I mentioned a couple times,
Problem
the
is it may
committee's
be negative
views
data.
are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if.
I know in the comments, guys, it's like load up, let's go to 3 to 5. Yes, that is the case. But if we are in a situation where we go into a market correction further, remember that in the last market corrections of past Bitcoin, it's been 80% in terms of fall. That would put us at 19, or excuse me, put us at 13, but a 19 was our past all-time high. So there's some very interesting.
Thank you, Chair Powell.
points.
I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry,
For sure.
what was your
Watch.
question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse?
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So,
Yeah, from 90 billion coming
but
off
you
the
have to
books.
you have to understand the context. Really the context is this: for
Sidestep.
decades before
Okay.
the pandemic and the reopening, you had
So
a
yes,
world
QT
where
is going to cause more pain,
dominated
and they're getting ready
by
to take 90
disinflationary
billion
forces
off
such
the
as
balance sheet.
declining population or
out of the
aging
markets.
demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So
Holding in around 21.5
we have now
right here.
experienced
So,
an extraordinary
waffling for
series of
sure,
shocks,
but
if you think
definitely
about it. The
not
pandemic,
not yet. The
response,
news is
the
not out
reopening,
yet, and nor is the
inflation,
analysis. I think a lot of
followed by
whether
the war in
CNBC or the traditional markets will be cutting
followed
this up.
by a shutdown
Over the next
in
24,
China,
we'll probably see some
war in
different
Ukraine,
addresses.
potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it.
Subscribe on the video. This is the number one. If you guys like these restreams like this and a little bit of commentary, a little bit of data,
about
let
what
us
all
know.
that
We'd
means.
love
You
to
don't. The thing
kinda
is,
get your
you don't know
insights
whether
too.
those
Do you like it?
forces
Do you not like it?
are. To what extent are they going to be sustained?
We're
In other
definitely going to do a
words,
breakdown
will we
of
go
this
back to a world
later.
where that looks a little more like the
assess
old
it a little
world, or
differently.
We're really going to be in a world where
Again, for those of you who just joined, what are your thoughts so far? 75 basis points hit. He's sidestepping a lot of questions around the potential towards recession and also the potential toward not only credit but also unemployment. So with those kind of scenarios in play, do you feel like this is hawkish or dovish?
in this new world.
Those of
and
you who just
maximum
jumped
employment
in.
in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely
inflation
extraordinary.
is
not just here.
is a lagging indicator. It's the one that the market has responded to different scenarios that's been pent up over scenarios. He's kind of trying to paint it out, that it's a different situation. The difference is that we printed, a few $1 trillion in money and injected that into economy without, with reckless abandon. And of course, you're going to see these kinds of reciprocities or whatever.
Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been.
I think Bitcoin is getting there, but I do feel like we're in for some more pain. These sentiment numbers are not, we've been watching this. It's not something that, from the minute, if you go back here to 610, we started at 64. Bitcoin literally started coming off the charts at that time. We saw a 25K, we saw a 22, a 23, and now we're at a 21. Came into a 20,000 Bitcoin last night and hovered in this morning. Sentiment, again, not good right here, Bitcoin, all the way.
And all that, of course, given
And as I
the
said earlier, we have not seen a sub 60
sensitivity around the
sentiment
housing market,
on
given the fact that it
Bitcoin
was
in the history
a
of
trigger
our own
for
power
the
index.
financial crisis
So
of
this right
decades
here
ago.
is at risk of being the lowest
So
in the
rates
history
were
of
very low.
consumer sentiment as it pertains to Bitcoin. Top line sentiment versus amplification. Amplification is more of a leading indicator in sentiment that we measure. It's holding right now at a 59.66 again, sub 60.
It was 14%, and
get back
true
to
unemployment
Chair
rate
Powell.
was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So,
Okay, let's
In the
go over to
meantime,
the
while
sentiment
rates were
poll
low
real
and while
quick.
demand was really high,
Take a
obviously
look.
demand for
Okay, how will
housing
crypto market react?
changed
Negative by
from wanting to live in
62%
urban
holding
areas
that.
to some
Okay.
extent to living in single-family homes in the suburbs, famously, and so the demand was just suddenly much higher. And low, so we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices?
How does the Fed
You know,
say
not really sure. It's,
on that question of how this is going to affect residential housing?
I mean, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online.
Oversupply,
whereas
higher
the-
interest
the
rates. What do you
supply of
expect you're
finished
going to get?
homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are.
That's the
are up.
lagging part
So
right
it's
there.
a complicated situation. We watch it very carefully. You know, I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and
So
demand
that just
are
pulled
back
people out of the market.
together, and where inflation is down low again, and mortgage rates are low
If you're
again.
a
So
home
this
buyer,
will be a
you need
process
a
whereby
reset.
we ideally we do our work in a way that where the housing market settles in a new place and housing availability
The mortgage bankers love
and
that.
credit availability are at appropriate levels.
Just as a reminder, business
So-
inventories are rising strongly. Sales are going to slow. We'll start to see more of this indicate on what might look in the future to at least some sort of correction, which is the only way we're going to see some some slowing of the CPI. And of course, he's done. This was, in my opinion, really just not a good look right now for the markets. Granted, the price, it was priced into as at least from a standpoint of 0.75 basis points. The bigger question here is going to be the layout of how all of this affects the aftermath. And this will be companies that are starting to struggle. If we start to see layoffs start to accelerate outside, remember, look outside the crypto market, start to look into traditional markets, and a lot of the Fortune 500. Take a look at that, and then some of the mid-market caps I think are very important because those companies trend a lot how overall aspects of what the industry might look like. So we're going to get to this, break it down for you guys a little bit more. Thanks again for tuning in. If you guys want to make sure and reach me, it's out on Twitter. Catch you next time right here on TechBath.